Hello everyone, and welcome to FXCM, the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. Today is Wednesday, it's the 1st of Feb. Please take a look at my email address, r@fxcm.com. Can I just double check that you guys can hear me, see me, and see the screen? Just want to double check that. Okay, excellent. Thanks, guys. Right, let's just bring up the high-risk investment warning. I'm going to keep this on screen for a few moments as well. We'll just go to the top of the hour, then we'll switch and we'll go on to our crypto minute. Here is our market commentaries disclaimer. And just our references, Market Scope 2 and Trading View. A few things I want to show you this morning. Again, similar theme. We've been looking at this theme now for regularly. We're always starting with the real rate. What I want to show you is the correlation with the US dollar. It's reasserting, it's gone back up to 70%. So we've got the real rate, the US dollar, and then the correlation. I think the correlation is meaningful. Why do we keep looking at this? Because really, real rates are driving the economy at the moment, and we've got the Fed release today. We're probably going to get a 25 basis points. What really is key is the communication from the statement, and particularly the press conference, right? And I think, excuse me, and I think we want to see if we get price or the yield dropping below this trough. And if we drop below this trough, then on a weekly basis, we have a lower peak, lower trough. And that, I think, makes a world of difference. Now, something else that I think is worth taking a look at just before we get onto the chart analysis, I'm putting forward the slides for Outlook 2023. I just want to show you the one slide. This is the Fed funds futures, and you can see that the Fed funds futures has a peak rate priced in for June. So you've got this parabola, kind of moves up and then it moves down. This is for 2023 from January through to December. So here's the market showing you the pivot. Okay. Now we want to see if the Fed pushes back on this scenario, or if there is more of a relaxation, so to speak, in terms of Fed policy. And we've looked at the economics. The labor market's not as strong as everybody's saying it is. I'm not certain why nobody's looking at the underlying weaknesses that are glaringly obvious. So we want to, you can't see those slides. They're going to be for Outlook 2023, which is going to be next. I think it's next, it's on the 9th, which I think is on Thursday, next week, Thursday. I'm happy to send the slides after Outlook 2023, but join me for that. But the idea here is, so we've got the parabola, we've got the weakness in the data that is starting to really show itself. And then one more thing that we can take a look at. One more thing we can take a look at is this chart here. This is the US 2-year yield. Which one is it? It's the blue line. Okay, it's the blue line. So you take a look at the 2-year yield, and the orange line, well, that's the Fed funds futures. So the market drives the sort of prices. The 2-year is really based on monetary policy and Fed influence, and then the Fed funds futures really set by the central bank. And what you want to take a look at is the crossovers, the crossover events. So if we take a look at the crossover here, So it's the 2-year leading the Fed funds futures down. Crossover event here. There's a crossover event here. There's a crossover event here, and this all leads. It all leads to the 2-year leading the Fed funds futures down. Well, there's a crossover event here. Okay, Fed funds is roughly about, I think it's at 4.3% or so, and the 2 years at 4.2 roughly. But so we're getting, here's the crossover event. Here's the crossover event. So the crossover event is, it's happened. In other words, the crossover event, here's another one, I've missed one. These crossover events are meaningful. The 2-year leads the 2-year leads the Fed funds futures down. You're going to get, Anna, you'll get an email. You'll get an email for an invite. You'll get that imminently in the next couple of days. So also, I'll start posting the registration link from next week. So you'll certainly be able to watch it. I won't not post the link. I'll post the link. So let's just reiterate what we've spoken about so far. We've spoken about the fact that there is a correlation coefficient that is reconnecting between the dollar, the real rate. The real rate is going to be heavily influenced by Fed. We don't have a downtrend yet. We want to see if we've got the downtrend. We've got the Fed pivot that's priced in. We want to see if the Fed pushes back on it or actually starts accepting that, given how weak the data is. And we've looked at the data, and then we've looked at the crossover events between the 2-year yield and the Fed funds futures, and you can see they're all pointing to a pivot. The only one that's not accepting the pivot's the Fed, which is, of course, the most important party here. They're pushing back on it. So we've got today's going to be a very, very important Fed announcement. If you are in the market, I urge caution. There is going to be volatility. Okay. Having said all of that, what I want to do is I want to just go through our methodology. I think there are some people, there's some new sort of names that I can see, and I just want to run through the methodology here. We've got just a few minutes, so we start off with the weekly. We want to get an idea of the weekly trend. I put this on a logarithmic chart for a longer term analysis. You want to keep it on logarithmic, and you basically want to put in your peak and troughs, because your peaks and troughs are what determines your trend. And here you can see on the dollar, we've got a lower peak, lower trough. We can actually carry on with the labeling here. You can put in another lower peak, which we'll call it LP, and you can actually put in the next LT. Now, if there's a rally on the greenback, so be it. It doesn't change the fact that we're in downtrend. Okay, the only way this changes is if we take out the lower peak. Because if we take out the lower peak, well, I beg your pardon, there's two ways to change it. If we take out the lower peak, then it effectively disrupts the definition of a downtrend. A downtrend is a series of lower peaks followed by lower troughs. Well, if all of a sudden you've got a higher peak, then you don't have the definition of a downtrend. At the same time, okay, if you get a higher trough followed by a higher peak, this actually is an uptrend. The taking out of the lower peak, that's just a disruption. But in lower trough followed by a higher trough followed by a higher peak, that's actually an uptrend. That would be significant. We don't have a disruption, nor do we have an uptrend. We've got a downtrend. Then what we look at is RSR. The RSR, I don't really look at divergences. I think they work sometimes. I think they don't work a lot of the time. But what I think does work is the position relative to the 50 line. Are we above 50 or are we below 50? The 50 is the line in the sand. Below 50 is bearish momentum. Above 50 is bullish momentum. And of course, we're below 50 here. So we've got a downtrend with bearish momentum. That's on the weekly. Now, what we want to do is we want to synchronize the daily with the weekly. And the way that this is generally synchronized, we use zones here. These zones are just Bollinger Bands. The first Bollinger Bands, this blue band, it's a 20 moving average and a 0.75 standard deviation. And we've taken out the average line. So we don't want to see the average line, because if you add the average line back in, then it messes with your zones. We only want 3 zones. Here, all of a sudden, we've got 4 zones. So just make sure whatever software you're using, you take out the average, and then you've got 3 zones. So you've got zone 1 is the upper blue, upper red. That's your bullish area, your bullish channel. You've got zone 2, that's your neutral channel, that's between the 2 blue lines. And then you've got zone 3, which is below the lower blue and the lower red. I haven't told you guys what the red is. Let's just go through the red. The red's just your standard Bollinger, 20 and 2. Okay, it's just 20 and 2. And then you can see, so we're in neutral here. Now, to be quite frank with you, I'm not surprised we're in neutral, because we've gone into the Fed meeting. Okay, the Fed meeting started yesterday. It concludes today, and they come out with the with their recommendations and the conclusions, etc. And we've gone into zone 2, so there's neutral, but that neutral is within the confines of a downtrend with very strong downwards momentum. And I wouldn't be surprised to see us fall back into zone 3. In fact, if you take a look at yesterday's candle is quite telling, is what we call a gravestone doji. In other words, market participants try to take price to the top. Let me rephrase that. Market bulls try to take price up. So they took price up until the high was reached. At the high, they lose control, and the bears pushed it down. Why did the bears take over yesterday? It's because the employment cost index, which is really what the Fed is worried about. They're worried about employment cost, wages, getting caught in this wage spiral. That came in benign, came in under forecast and lower than last month. Bulls lost control. So we're kind of heading back towards the zone 3. And then again, to really get a swing, we look at stochastic. And that stochastic either is above 20 or below, or above 80. If it's below 20, you're going to get a swing down. Most likely you'll get a swing down, not always, but 90% of the time. If it stays above 80, you'll get a swing up. There's no such thing as overbought, oversold in the stochastic. The mathematics doesn't allow for that. The RSI, there is overbought, oversold. So while I won't look at the divergences on the RSI, I will look at overbought, oversold on RSI. And then we go through to our hourlies, and this is where we really try and time the market. Now, you can see that the dollar here is starting to roll over. So in other words, money seems to be flowing out of the dollar. This is interesting. So what did we say? Let's just go. We've got a downtrend here. We're in neutral, but we saw weakness yesterday off of this gravestone doji, and we've now got the dollar being pushed to the downside. And we've got another movement down here on the stochastic. And if the stochastic hits 20 and below and holds, we'd probably get a swing. Probably. I mean, I can't say for certain, but 80–90% of the time, I would suspect you swing. That's where magic happens, right? So the obvious question is, well, what's the big deal here? Why is money moving out of the dollar? Well, think about it. Why would money be moving out of the dollar? Dollar is safety. People probably expecting some sort of dovishness out of the Fed. Now, huge caution here. Just because people are expecting it doesn't mean that the Fed's going to deliver that. So all the people that are building short positions here, if the Fed comes out with a hawkish statement, they're going to get absolutely hurt with the volatility to the upside. There's something else I want to show you, and then we will move over to the crypto. Okay, so we've got a downtrend. We've got a sort of a neutral, but I would say that there is a bias towards the downside here, given yesterday's gravestone doji. Well, we've got a pattern here. Okay, we've got a head and shoulders top. So all of this is looking really, weak. The dollar is looking very weak at the moment. If you go through to the euro, you should see some euro to the upside. Let's see, yeah, here's euro to the upside. You should get some NASDAQ to the upside as well. Let's take a look. You're getting some NASDAQ to the upside. I traded NASDAQ yesterday. I caught this over here, but I'm not going to hold it. I've exited the position. I'm not holding it over the Fed announcement. It's too risky for me. Okay. The idea here is the dollar leading the market really reflecting what they think is going to happen with the Fed in the greenback. And if you go through to this chart here, this chart here, which is the real rate, you go down to the hourly. Surprise, surprise, we're getting lower peaks here. Low peak, lower peak, but a little bit of perhaps, this is interesting, we're right at support. Again, I want to reiterate, it's a tricky day. Okay, don't try and outsmart the Fed, okay? Because if you're right, you'll make money. If you're wrong, you'll lose money. Losses, you know, can really compound if you're on the wrong side. So be very, very careful. All right, with that all said and done, what we're going to do is we are going to conclude here. We'll carry on. We'll have a brief look at the two main cryptos. We'll take a look at Bitcoin. We'll take a look at Ethereum. Please join me for that if you are in a region that allows for it. Thanks very much, guys.